HR issues can kill you. One complaint against your company can turn your world upside down. And you spend way too much time dealing with HR when you should be spending your time on making a profit. You should talk to Bambi. With Bambi, get access to your own dedicated US-based HR manager starting at just $99 per month. They get to know you and your business while providing HR expertise and the personal touch you need and want. They're available by phone, email, and real-time chat, so onboarding and terminations run smoothly. Team members reach peak performance, and your business stays compliant with changing HR regulations. And with Bambi's HR Autopilot, you'll automate important HR practices like setting policies, training, and feedback. HR managers can easily cost $80,000 a year, but Bambi starts at $99 per month. Schedule your free conversation today to see how much Bambi can take off your plate. Go to Bambi.com right now and type in Accelerate under podcast when you sign up. It'll really help the show. Spelled BAM, BEE.com. Bambi.com. Type in Accelerate. Welcome to Accelerate Your Business Growth, where we're exploring all sorts of business topics. Experts from around the world join me, your host, Diane Helbig, for a conversation where they share their expertise with all of you. Take what you need when you need it. Featured on Inc.com, Forbes, and MSNBC's Your Business, this podcast is recognized as one of the best podcasts for small business, sales, leadership, social media, and more. When it comes to business, Accelerate Your Business Growth has got it covered. And now on with the show. My guest today is Mark Myers. Mark served in the Marines for over 8 years and received the Distinguished Medal Award and the Robert A. Met Award for Outstanding Leadership. Today, he's the founder and CEO of Peak Profit Solutions, a financial services company that for over 15 years has helped thousands of business owners permanently reduce their tax bill on average by 50% without replacing their CPAs or financial investment advisors. Thanks so much for joining me today, Mark.
Diane, thanks so much. It's really a pleasure to be with you. I'm looking forward to talking more.
I am too, because, this is one of those subjects that people don't want to talk about, but they know they have to talk about. And so any good news we can give them, that'll be good, right?
Absolutely. Taxes are something that people a lot of times they think that they just have to pay it, and they don't pay a lot of attention to it. And if you do, you could be pleasantly surprised that you could keep a lot more of your money. So that's a fun conversation to have with anybody that's in pain when they're writing those tax checks. So it'll be fun.
Which we all are. So, okay. So seriously, how can business owners save money on taxes without spending all of their profit?
Great question, Diane. So the first thing we have to do is we have to identify the coupons that are available for them that will reduce their tax liability. And I always when I say coupons, Diane, I am actually speaking about specific tax code. For example, it might be section code 162 or 281A or, 831B. It really just depends. But I always call them coupons so I don't sound so nerdy. And now we just look at how many coupons does this individual have that are relevant to them, right? And there's 75,000 plus pages of tax code. Interestingly enough, the first 5,000 or so tell you how to pay your taxes, and the next 70,000 plus give you all kinds of opportunities to pay less if you just know how to follow the code. So I always say, let's find the coupons. So that's the first step. Is I have a nice little kind of a consultation call with anybody that's interested. It only takes usually 20 minutes or so for me to identify if they're a viable client that has a number of coupons. And then we say, okay, coupon A, coupon B, coupon C. If you participate in these tax codes this year, this is how much less taxes you'll pay. And this is how much your out-of-pocket cost will be. And that obviously you want that to be a delta. That's a nice saving. So if you can spend $20,000 and get $100,000 of tax
Sure.
savings, that's a pretty good deal, right? So that's what I'm always trying to accomplish for clients.
Okay, so and this is one of these situations, it sounds like, where you can stack coupons on top of each other.
Absolutely. The more
Huh.
coupons we can put together, the better. But here's the thing, interestingly enough, sometimes more is not better. Sometimes I'll say, well, you can do
Really?
5 different coupons, but if you only want to do these two, they're going to give you 90% of the benefit. But if you want to do the extra 4 coupons or 3 coupons to get the extra 10% and leave nothing on the table, let's do it. Right. So it really is up to the person I'm speaking with.
Okay. I got to tell you, I mean, so on a certain level, that sounds pretty understandable. But then I think, oh my God, there are so many pages and so many codes. How in the world do you figure out which apply to who and what's out there? And does anything override it? I mean, it just feels complicated to me.
Well, Diane, I love that you brought that up because it is pretty complicated, but that's why I do what I do to bring the complicated matters and make them simple for those that need them. Because if you think about it, Amazon, Nike, um, Cardinal Health, Medtronic, I mean, you name it, these large 1,000, Fortune 100 companies, they don't pay taxes. They pay
Yeah.
very little taxes. Why? Because they have sophisticated attorneys,
Yeah.
a number of accountants, not just one, right? Most small to medium sized business owners have one accountant or a small accounting firm, an advisor or two that helps them with their investing. But they don't have a team that's essentially saying, oh, we know the code and we know how the coupons apply to you or don't apply to you. And we can make it turnkey for you. And that's what I do. My business literally, it didn't start out this way, Dan. I didn't initially start out being the tax strategist, but I found over the last decade that there's not a lot of people that are focusing intently in this area. And I wanted to fill that gap. So I know, and I'm not like a savant tax attorney. I'm also not a CPA, but I'm an explorer, and I've looked for these coupons, and I find them. I do diligence them. I have tax attorneys on my team and CPAs on my team that help me do diligence them once I find them, and then of course I put them in my toolbox. So now when I'm speaking to someone that has a tax problem, I'm just saying, hey, right now I've got about a dozen different coupons that work really well. And I can just tell them pretty much immediately how many of them that I have available would work for them and how much benefit that would provide them. And I'll help them coordinate. They don't have to figure it out on their own.
All right. So going down that road, what financial professionals are like critical to hire? And are there points in a business journey where certain ones are more critical than others?
Yeah, I would say, obviously having a very good accountant and tax professional, tax preparer, and a bookkeeper are going to be great on your just organization side, particularly if you're a business owner. Now, of course, if you're just a high income earning W-2, then you don't necessarily need that. Um, and then you have a really good financial advisor, right? Those are the two, I always call it, if you do an analogy of baseball, you've got your pitcher and your catcher, right? And that's all a lot of people need when they're making a couple $100,000 a year. But once you start making 400 and a half a million and a million and 3 million and 10 million and the up and up and up, and now you need more than a pitcher and a catcher. You need a first baseman and a second baseman, maybe a right fielder. So that's when I come in and say, outside of your CPA and your trusted financial advisor, maybe your insurance guy or girl, now you need to start adding new teammates. And these teammates are essentially business strategists or attorneys that work on certain areas of the tax code and bring that benefit to you and your business or you and your individual tax situation to help you reduce tax. So I guess, that's the best. I can't really tell you who they would be until I know what
Right.
strategies are needed.
Right. Right. I get that. Thank you. That makes a lot of sense. I'm glad I asked the question. So, all right. So let's talk about cash flow, because this is really, in my opinion, the biggie for small business owners, that they really don't necessarily understand cash flow, and so they end up in trouble. So, how do we measure it? And will you explain to the listeners why it's so important?
Oh, for the business owner, Diane, so just as well as I do, it's the lifeline of your business. Obviously, leads are the first lifeline, and then of course the cash flow to service the leads and essentially buy new, however you're marketing and servicing your clients. But this is really important because when, most tax planning, right? If you don't, most small to medium sized business owners do not treat their tax liability like a profit center. And that's what the larger companies do. They're like, okay, we have this tax liability. We need to focus on it because the smaller we can make this tax, the more profit that we have, particularly for our shareholders and our
Right.
they shift our focus because now if because you're thinking about your tax liability and you're thinking about it like a profit center, you're not just meeting with your CPA, your tax professional in April and saying him or her saying, well, how many expenses did you have last year? Or maybe meeting them with them in November and saying, well, how much more can you buy? Can you buy this? Because we can get you a deduction. And I always say, never buy something for $1 just to save 35 to 50 cents, depending on where you live, right? That makes no sense whatsoever.
Yeah.
So if we start planning in January, February, March, April, we can say, hey, you don't have to pay these taxes that you're accruing. Like maybe we can reduce your W-2 withholdings and also your quarterly estimates. Why? Because we can divert those dollars into alternative resources that are going to give you significant tax savings, and that's going to give you more cash flow on a month over month basis, particularly if you are, reducing that quarterly estimated payment because you realize you're not going to need to make it because you're planning ahead as opposed to waiting till the end.
Okay. So it's really strategic planning consistently, right? That's what it sounds like to me, where you're always looking at what are the best opportunities. It sounds to me like there's opportunities in a lot of different ways, not just looking for certain codes and applying them. I mean, that's what it's sounding like to me, because with the whole cash flow thing, you're looking at reducing your estimated tax payments. Okay. That's not necessarily right. I mean, that's real time as opposed to future.
Absolutely, Diane. It really depends. And I guess the way I would kind of explain it is when we evaluate the needs of the business. I'm assuming we're talking to a business owner. Just know I can work with high income earning W-2s. Like literally, I can still help them as well. But obviously, business owners generally have a little bit more flexibility with how they pay themselves because they generally control the flow of the dollars.
Yeah.
So they're easier to work with. But with that being said, I just identify, okay, these are the coupons, the tax codes that if you were to implement these things, it would give you more cash flow. And some of them don't. Some of them, I say, they might require some cash for you towards the quarter two or quarter three or quarter four. But if we can save those dollars, not send them to the tax man and save them for this opportunity, it would benefit you greatly. And, I'll give you one little, I can talk about different coupons. I don't mind getting into the weeds. I just don't. Sometimes it confuses people unless we kind of apply it specifically to their situation. But for example, there is a tax code that's been around for 50 plus years, and small to medium sized business owners, if they're not using it right now, they absolutely are missing out. And that is the fact that you can rent your primary dwelling unit, your home, to your business, and the income that you receive from your business to utilize your home for strategy meetings, business meetings, board of director meetings is not taxable to you up to a certain number of days per year. So if you think about that, if you can create a deduction, because we're always looking for deductions for our business, if we can create a deduction for our business that lowers the net profit, but that expense from the business goes to the business owner's personal bank account and is not taxable, that's a pretty good deal. And we can do that every single month of the year. So we can essentially reduce their W-2 payment and shift a portion of that that money to them as a rental for using their home for the purpose of strategy meetings or board of director meetings or any type of business growth meetings for their business at their home.
That's very a great example. That is. Yeah.
I love that one. Yeah. I call it the chip shot. I call it the chip shot because it was originated in Augusta, Georgia back in the 60s. And if you know anything about Augusta, Georgia, every year there's a pretty big golf tournament that goes on there. And somebody gets a great packet.
Oh my gosh, I love that example. It's so weird. Okay, so it just makes you wonder what the government was thinking. So talk to me about long-term capital gains on the sale of appreciated assets.
Oh, I love that question. And that up until now, Diane, I've been focusing mostly on income, like regular income that you earn from your business, whether it be W-2 or profit above your W-2 or K-1 income or interest on your investments, all things that have been taxed at regular income tax, which we know that can climb all the way up to 37%.
Yeah.
And the federal levels, and if you're brave enough to live in the beautiful state of California, which I did for almost 15 years and loved it, but you're paying 13.3% state tax at the highest levels there. Wow. So 50% of your profit goes to the government when you're in California. So now we're shifting gears and talking about, well, what happens? Well, maybe you don't make $1 million a year or $250,000 to $500,000 a year in regular income, right? Because I can usually help someone, a business owner as low as a couple $100,000 a year in regular income with some smaller coupons. But obviously, the more income you make, the more I can help them. There's a lot more coupons that become available as the income gets higher. But if we go to saying, hey, somebody might not make a lot of money every year, but they've got an asset that they purchased at the right price a few years ago, or was given to them by a family member, and now they're selling it, and they're looking at a hefty long-term capital gains tax, meaning that, hey, the basis on this thing was maybe $100,000, but I'm selling it for $1 million or $2 million, or maybe it's a business that they're selling that has no basis or very low, and they're selling it for $20 million or $50 million, or I've helped business owners that have sold businesses for well over $200 million. So it doesn't matter. Just note, it's obviously taxes are taxes. So let's just say they have on the federal side, you've got a 20% long-term capital gains tax, and anything over it's $500,000 if you're married filing jointly. So now if you have income on that long-term capital gains at $500,000 or more, well, you're paying 20% on that federal, and you might be paying, depending on the type of asset it is, you're probably paying the net income investment tax or net investment income tax, which is 3.8%. That's 23.8%. And then if you're in any state that has a state tax, like North Carolina or Georgia, or basically most of them, except Nevada and Florida and Washington and Wyoming, well, you're going to pay an extra 5 to 13%. So now you're looking at selling this asset that you've held for a long time, or someone gave it to you in the family, and you're looking at immediately losing 23.8% to as high as 37% in California just from taxes.
Wow.
So I say, let's make that tax burden go away. And the best way to do it is to plan ahead of time. I hate it when I have consultations with clients and they say, yeah, I heard you can help me with capital gains tax. And I say, absolutely. How much taxes are you paying? And they're like, it looks like they say, I'm going to be paying taxes on however much. And I say, great, let's do some planning around that. And they say, well, I already sold it. I'm like, wait a minute, you already sold it. It's a lot harder to help you after the sale. So I always like to say, if we can plan prior to the sale, we can either defer the taxes on that gain, or sometimes even eliminate the taxes on that gain. But I need to work with them at least 30 days or more prior to the sale to make sure they structure the sale appropriately. So I'll stop there. And if you want to dive in a little deeper or go in another direction, we can. But that's really the key with long-term capital gains. It's just making helping structuring the sale prior to the sale to essentially give you much more of an advantage with regard to that tax liability that comes with the sale.
I see. So what people need to hear is there are different ways of packaging a sale that are going to impact you or your business from a tax standpoint, either favorably or not.
That's right. And think about it this way. When you're looking at selling that highly appreciated asset, all the profit, all the income generated, that's the amount that you receive above what your basis
Mm-hmm.
is going to get hit with that tax liability. And what I say is prior to making the sale, if we adjust, because the key here, Diane, is we have to take away assignment of income. When you sell that asset and it's in the name, it's in your name or it's in the name of an LLC that you own. Essentially, as soon as you've sold that asset, or maybe even taken a binding letter of intent or signed a purchase agreement, even though it hasn't been sold yet, you've signed a purchase agreement. You've officially taken assignment of income. So the federal government says, well, even though you haven't sold it, we know that you signed the purchase agreement and your name is on it, and or the name of the LLC that you own is on it. So we know that you're on the hook for the taxes. What I say is, let's structure the sale. Let's move the asset out of your name or out of your LLC's name, and usually it's putting it into a specific trust. So now when the asset is sold, the trust is selling the asset, not you. So you don't have an assignment of income, meaning you don't have a tax bill. The trust does, but we can create a lot more flexibility within, depending on the type of trust and what we're working with, for the tax liability if it's there. So now it's like, sell it in your name, you got to pay the taxes right out of the gate. Sell it in the name of in the trust because you shifted the ownership into the trust, but you completely control everything in there and it's your money and you control it. It's just that now you have a better tax environment for that asset to be sold in, and now you can essentially keep the delta, right? So if you had to pay a 30% tax on it, you're keeping 30% in your bucket, and now you can reinvest that money and reinvest it again and reinvest it again, and you're not paying taxes on it until you actually take it out and use it. Kind of like a qualified account, right? The people's 401ks or IRAs, but the good news about this is there's not all the rules around it. I mean, there are rules, but not like, well, if you're not 59 and a half, then you have to take 10% penalty to touch this money. Or if you're 73, I don't care if you don't need the money, you have to take a minimum required distribution. Otherwise, we're going to tax you heavily. All those rules go out the door. You have much more control over accessing that and taking dollars when you want to, but you can still continue to defer all the gains, or maybe even eliminate the gains depending on the structure we're using.
That's fascinating. Okay.
Absolutely.
Yeah, I mean, almost makes my head hurt. So now talk to me about getting the IRS to fund a portion of my retirement 100% tax-free. How do I do that?
I love that question, Diane. So I can answer it in a few different ways. One way would be any coupon that you use, right? Any coupon that I come in and say, these are the 3 coupons that you could use. And you say, great, I want to use 2 of them, not the third. And we end up netting you. And I say netting, like, okay, you're saving $100,000 in tax, but it's only costing you $50,000 to do it. So your net gain is $50,000. Well, one way to just turn that into tax-free income is purchase, municipal bonds with that, or put it into life insurance, like cash value life insurance. So that way you never pay taxes on it again, right? That would be one way to go about it. But the other way is interesting. There is a coupon that it's been really popular for the last 10 to 15 years. And I'll tell you who it's been popular, who's used it, that's loved using it. Wells Fargo, Chase Bank, Bank of America, Jeff Bezos, Amazon, obviously NextEra Energy, Tesla. It's called a tax credit that you get for purchasing solar. The federal government, the House and Congress, or House and Senate, they've put into law, particularly last year, they want the private sector to buy solar. And of course, they've been creating these laws for the tax credit, mostly for Jeff Bezos and Bank of America. But the good news is you don't have to be Jeff Bezos or an owner of Wells Fargo to purchase solar and get the same benefit or better. So when we go into creating a kind of a pension for you with tax savings, purchase solar. And I'll go into it not too depthful because I don't want people to their eyes to cross over, at least until we look at but really what we're doing is saying you can actually purchase solar panels on a third party building. Particularly, it can be a church or a house of worship. It can be a YMCA, a museum, a private school. It might even be an apartment complex or a small grocery store. You're the one purchasing the solar on that building. The building owner is happy that you're purchasing the solar on the top of that building because they're not paying a dime for it. You are. But they're immediately getting usually anywhere between 20 and 30% energy savings in the very first year. And it gets better and better and better because they're signing an agreement that says whoever owns these panels, we are going to pay them for our energy or as much of our energy as we can because we still have to pay the utility company something for the next 35 years. We'll pay you for the energy. Why? Because it's going to cost us a lot less than paying the utility company. So that's a really interesting prospectus when you can buy a cash flow producing asset. And you can buy it with the federal government's money because the way that this works is when you purchase the solar, between the tax credit and the depreciation that you can take on those panels, you can actually get $1.40 of tax savings for the dollar of tax liability you put in. So instead of sending the dollar to the tax man or woman and never seeing it again, you can take that same dollar, buy solar with it, get $1.40 of tax savings and up to 35 years of cash flow on top of it. So I'll stop there because obviously I would need to talk about the details in someone's specific situation. But really what I'm saying is people love to buy real estate, right? They buy real estate for cash flow.
Sure.
Well, what if I said, well, let's have the government buy your real estate. It's just not going to be a duplex. It's going to be solar on the top of a grocery store in California. And you're going to get, for every dollar you put into those panels, you're going to get $1.40 of tax savings. You're also going to get cash flow for as long as you want to own the panels, up to 35 years. You don't have to own the panels for 35 years, but if it's kicking out cash flow for 35 years, you might want to hold on to them. That is a unique opportunity that we have 10 more years based on the Inflation Reduction Act that was signed into law last September, putting the tax credit at 30% minimum all the way up to 60%, depending on the location and the type of solar panels that were installed. So that is a beautiful way to turn your tax liability into long-term income and let the federal government pay for your cash flow producing asset.
Wow. That's insane.
Yeah. Well, they want to make America a greener place, and this is
how they're doing it. Yeah.
We're helping to do it. Yeah. So.
Well, you have to incentivize people. That is for sure. So I'm so glad we're having this conversation because just the couple of examples that you've given, and I really appreciate them. What it shows me is the creativity that is available, that is out there, because I think we're so used to feeling like the tax structure is very structured, and very like we're in a box. And there's no real way out. But I'm listening to this and thinking, boy, there's all sorts of creative ways to use it to our advantage.
Absolutely. And I want to say something, Diane, and hopefully it doesn't rub anybody the wrong way, particularly if they have a CP and an A behind their name.
Okay.
But, your CPA is generally going to be the most conservative resource on your team.
Yeah.
And most business owners or, high income earning professionals rely on that CPA to help them with their tax liability. But CPAs most of them do not have the bandwidth nor the desire to seek out these coupons and help their clients apply them. They just look at what was your expense line, what are the standard deductions that can be taken, what are the obvious expenses or deductions that you can take at the business level. Are you missing any of those? If you're not, great, let's file your tax return. If you're making a lot of money, that's just good work. That's just the pain that you have to endure for being very successful. That's generally what a CPA is going to say. Now, I'm not saying that's horrible. What I'm saying is it's not the case for high income earners, particularly think about most of the Fortune 100 companies. If that's what was said by their tax professionals, then they would be fired. Right? They
Yeah.
say, no, we're going to pay a lot less tax and we need to find somebody that's going to help us. But again, CPAs are not geared to do this. So this is where when you're starting to make a lot of money, don't hold it against your CPA. Just start building the team. And now the team can bring these ideas and ultimately help your basically put them in place and show your CPA how to file for them, because there's usually a little bit of additional filing work that needs to occur. And that's really where we go. So just know, like, that's, I always like to say, like, think about your CPA as a general practitioner in medicine. Well, I wouldn't rely on my general practitioner in medicine to help me if I needed a tumor removed from my frontal lobe and I was about to die. Well,
Right.
if that's the case, I go to a very specific neurosurgeon. I knew what they were doing, and I wouldn't rely on my general practitioner to tell me if they knew what the neurosurgeon was doing or not. I would, so that's really what happens. The CPAs sometimes can get a little bit in the way. But if they know that, again, a lot of times the reason for that is because they don't like audits and they don't want you to get into an audit. Nothing that I'm going to do is going to trigger an audit, but essentially that's anything outside of the norm, usually they
Sure.
think it's going to trigger an audit. And
Right.
the other side is, I would say that, they, again, because they don't know outside of their scope, they don't want to apply outside of their scope. And usually if you go to like a Deloitte or a Price Waterhouse or some really, kind of consulting based group that does accounting and bookkeeping, tax filing too. Well, they do it all, and your CPA is never going to want to refer you to them because then they'll lose their business. So the good news about what I do is I don't step on their toes. I don't do bookkeeping. I don't do tax preparation. I don't do tax filing. So when I'm bringing these coupons in with a business owner, I'm just helping them layer this in with their current CPA. And if their current CPA is very resistant and the business owner really likes what I'm saying, fine, I've got 25 CPAs that have been doing this for a number of years that would love to interview you. I would love to have your business. Not that I want you to leave your CPA.
Right.
I'd love to work with your CPA because
Sure.
most of my business comes from CPAs or financial advisors. And it's the CPAs that are like, wow, where have you been for the last 10 years? I've got 100 clients that need your services, and I'm not worried about losing my business because I'm referring them to you. That's the wonderful CPA introductions that I have. And then, of course, financial advisors, they have so much compliance, they can only offer whatever retail investment they have in front of them. They
Yeah.
can't offer anything else. So now they love it because I can help their highest income earning clients just have more money to invest with them. So most of the financial advisors and forward thinking CPAs that are not ultra conservative are going to refer business to me. And that's where I get the bulk of my business is from those referrals or people learning about me through like a podcast done with you or some other thing that I'm doing that helps the end customer find out that, hey, there's more that they can do than they probably know about.
So I do have one other question, which is there like a threshold below which these opportunities are not really opportunities? In other words, would you say someone has to be making above a certain number? And if so, what is that number?
Sure. Let's talk about regular income, particularly for a business owner, right? Because the business owner can control how they receive that income.
Mm-hmm.
I can help a business owner that can control their income, reduce their taxes if they're only, well, I'd say not only, but let's just say they're making $150,000 or more of
Okay.
taxable income, AGI. Once you hit $150,000 or more, and you're a business owner and you can control how you receive those dollars, I can help you. Anything under 150, probably not worth it. I mean, the savings start to get pretty thin for the
Yeah.
amount of effort put in.
Okay.
But now, so 150,000 more regular income taxable for business owner. Let's move to W-2, right? The more the better, right? If they make $1 million, it's a lot better
Sure.
because they have a lot of options.
Yeah.
W-2 earner, less opportunities. So they need to, if they're making $500,000 or more, like, right, they have a salary plus a nice bonus, and maybe they're getting RSUs, like restricted stock units that they have to exercise every year, and they're obviously getting hit on those taxes. So $500,000 or more from a high income earning W-2, I can help them. And then, of course, we switch gears to capital gains. If they're going to be paying $100,000 or more in tax on their capital gain, that's kind of the starting point, right? If they're looking at, wow, I'm going to pay over $100,000 in tax if I do nothing on this capital, on this selling this asset. So those are the starting points. 150 of regular income as a business owner, $500,000 or more of income as a W-2 employee or executive, and then paying more than $100,000 of tax on their capital gain, which is usually like $400,000 total income on the sale or more, depending on the state.
Got it. Thank you for that. And for all of this information. I mean, it really is valuable. So how do people find you?
They can go right to my website, peakprofitsolutions.com. And again, that's just peak as in mountain, PEAK, profit solutions, peakprofitsolutions.com. And I have case studies that they can click to receive. I have a little more information. And also I have a link to my calendar, which makes it super easy. They can literally just book a 20-minute appointment to say, hey, I want to chat with you. I heard you on the podcast and I have this is my tax liability problem. I'd love for you to help me. And usually within the 20-minute conversation, I can identify whether or not I can and what coupons are available. And then we can talk about running an analysis to see just how much money they'll get to keep if they implement coupon A, B, C, D, E, F, G. So that's the best way. I think it's just to find me there and reach out, and we have a nice little conversation.
Awesome. Wow. Well, Mark, again, thank you so much. And listeners, thank you. You are who we're doing this for. Thank you for tuning in to this episode of Accelerate Your Business Growth, a production of Evergreen Podcasts. Discover more episodes of this podcast and explore others at evergreenpodcast.com. As always, continue to prosper and be curious. And if you're looking to get your sales strategy headed in the right direction, pick up a copy of Succeed Without Selling on Amazon or wherever books are sold. Until we meet again on another episode of Accelerate Your Business Growth, goodbye and good day.
The average person experiences up to 10,000 marketing efforts each day. Those ideas are culled from millions of possibilities. The CMO Confidential podcast takes you behind the scenes to learn about the decisions, drama, politics, and glory that go with one of the most scrutinized jobs in the executive suite, the Chief Marketing Officer. Guests from all over the business world join Mike Linton, a 5-time CMO, to share stories about what it's really like in the marketing universe.